Welcome to the New Books Network.
Hello, everyone, and welcome to another episode of the Princeton University Press Ideas Podcast, a joint production of Princeton University Press and the New Books Network. I'm Mark Clovis, and today I'm speaking with Leah Downey, author of the book Our Money: Monetary Policy as if Democracy Matters. Leah, welcome to the New Books Network.
Thanks for having me, Mark.
Well, thanks for agreeing to be on our show. I was wondering if you could start us off by telling our listeners something about yourself.
Sure. I am from North Carolina, and I currently live in London, and I am a research fellow at Cambridge University, St. John's College. My academic background, I normally probably wouldn't go into such detail, but it is a bit relevant to the book. So, my academic background is that I started as an undergrad, as a math major, before deciding that while I loved pure math, I thought it was totally beautiful and mesmerizing. I actually wanted to do something in my life that had a little bit more to do with people. So I added economics as a second major and quickly got obsessed with economics and sort of fascinated by it. But a bit unsure of exactly how it all worked. And I had this fantastic advisor as an undergraduate who said to me, okay, Leah, let's do a reading course. And so we spent an entire term slowly and meticulously reading Joseph Schumpeter's Capitalism, Socialism, and Democracy. And after that, I decided what I really wanted to be was an economist, but not of the sort that you found in most modern economic departments. So I went off to do my master's at the London School of Economics in a joint master's in economics and philosophy. And after that, found my way into a PhD program in political theory. So I only tell you all of that, excuse me, because essentially to say that my academic background I've been interested in monetary policy and economic policy for a very, very, very long time, but it just took me quite a while to figure out the right disciplinary home to write about it in the way that I wanted to. And that's what this book is.
It's a really fascinating set of skills that you bring to this in a very, and to me, a very unique perspective. I don't presume to be an expert in economics, but what little coverage I've had of the subject, I've never seen this intersection between economic policy, monetary theory, and political theory. What led you to make that your focus, and in particular, to focus on this question, which seems so relevant and yet seems so very vaguely addressed about the notion of democratic theory and how it can shape monetary policy.
Yeah, no, it's a fascinating thing actually, in academia because there are these little pockets of sort of space where there are topics that are really related to our lives, but that don't quite get discussed, I think, in the most relevant way. So I think monetary policy is one of those, which tends to get relegated to the world of economics and public policy and not focused on very much by political theorists and democratic theorists. Now that's changing a little bit. Today, there's more political theory that's concerned with the state and its institutions, and also money in particular, and sort of the history of money in political thought. But that's still quite a fresh topic for political theorists. And I just feel it's essential. I mean, I think it's essential for a few reasons. One is that the monetary powers of the state are, in my view, one of maybe two or three of the most essential powers that a state holds, especially a democratic state. So that makes them, in my view, essential for political theorists to focus on. But second, that it's an interesting and important thing for political theorists to do, I think, to take abstract theory and shove it into the world and see what happens. And that's kind of what I've tried to do with this book is go back and forth between sort of traditional democratic theory and monetary policy and how it actually works. And I find that a very productive way of working because I learn from democratic theory things about the way that the world is working or not working so well in terms of monetary policy. And then by looking in depth at monetary policy and how it works and how economists think about it, I feel that I've discovered gaps in democratic theory as well.
I think that comes across very well in your book. And one of the things that I found most refreshing when I read it was this this idea that the very notion that there should be democratic input in monetary theory. In the United States, I there's this we sort of have the notion of monetary policy and the institution that is tasked with managing it, that sort of in popular imagination, the Federal Reserve Board, sort of on a pedestal, and this idea, and this, I mean, I grew up with the age of Alan Greenspan and his kind of his very gnomic prognostications, very vague, this idea, which created this aura of that this is something that's so sophisticated, so complicated, pay no attention to the man behind the curtain type of thing, and the
Hmm.
idea that it's something that we as citizens should trust to them because it's beyond our understanding. And it occurred to me as I'm
Hmm.
reading your book how that very perception, mitigates against this notion that there should be a democratic influence upon monetary policy, which is the argument that's at the heart of your book.
Yeah, no, absolutely. I mean, there's a few ways in which monetary policy is projected as essentially unique, right? And that's true in some contemporary economic theory, but as you say, it's definitely true in just the popular conception of how it's governed. And as you say, of Alan Greenspan, I mean, he's very famous for saying something to the effect of, if Congress can understand what I'm saying, then I'm doing it wrong, right? So that it was an intentional
Yes.
obfuscation for sure. And that's really changed since the 90s. There's been sort of a big push to make monetary policy and the Fed more transparent. And in an effort to do that, make Congress, give Congress better capacity to hold the Fed to account. And that I think has all been for the good. But essentially what my book is saying, we can't stop there, right? It's not just about ensuring that the Fed is adhering to its instructions from the legislature, but it's about making sure that the legislature, as the democratic body meant to, make law, is actually empowered to deploy and steer monetary policy. And the belief there really is the one that you're pointing to, which is that money and democracy, I think, are just inherently related to one another, right? If we think of democracy as the sort of political mechanism through which a people can collectively, as equals, shape the future, right? Then absolutely key to doing that is the power to create, regulate, and allocate money.
You open your book by your opening analysis by talking about contemporary monetary policy through this lens. I was wondering if you could talk about the ideas that shape monetary policy and the degree to which they do or they don't really have any sort of connection to democratic theory.
Yeah. So I think one of the main things, one of the main theories that's kind of sits at the foundation of the contemporary monetary policy sort of apparatus is this concept of monetary neutrality, which is pretty ubiquitous in economic theory. And essentially, the idea is that money is neutral to real economic production over the long run. So, what does that mean? Well, the idea of this goes back a long time, back to people that democratic theory claims as theorists themselves, right? So, John Stuart Mill and others talked about the fact that essentially dollars and cents don't physically go into the production of goods and services, right? So they're not actually essential to making things. They merely grease the wheels of trade, so to speak. And so the foundations, the fundamentals of the economy, how much labor we have, how much what technology we have, how much capital we have, those things are not influenced by money. Money simply helps us put them together more efficiently, right, to produce. But of course, that the claim in economic theory is that that's true over the long run. But in the short run, money can, of course, influence production because money influences who produces what, where, and when, right? As we all know very clearly. And my view is that while that might be a theoretically convenient theory, it's not really useful in reality, because the long run that that theory talks about, the equilibrium concept of the long run, is not a point in time that we ever get to, right? We live in a series of short terms, and in all of those short terms, money is influential on what is produced. And so that's one basic idea that I challenge in the book that is pretty foundational to the idea of central bank independence, for instance. And I disagree with it, I suppose you could say.
It's Yeah, I want to actually go back a moment to a point you're making earlier, which is the notion of how what you're doing here is you're not introducing a new concept, as you've pointed out to. It's embedded in the very structure of the government. You point out how in the Constitution, Congress is empowered to to deal with monetary issues. It's written into the text of the Constitution. And that over the course of a history that we're not going to get into because it's not relevant to your book, Congress dealt with it in various ways up till 1913 when they create the Federal Reserve System. I was wondering if you could explain a bit as to what exactly the Federal Reserve System is in terms of the argument you're presenting in the book, and how it is that Congress has ceded so much of its responsibility over monetary policy to the Fed, not just in 1913, but as you point out, 1927, 1978, right down to the present day.
Yeah, no, I think this is a really fascinating question, and it's also in a certain way a useful thought experiment, right? Because essentially what happened in reality is that in 1913, the US Congress decided to form a central bank in the form of the Federal Reserve. And the impetus for this really was the 1907 financial crash. There was a huge um, financial panic, and private banks were essentially deployed by the government, sort of, impressed upon to solve that problem, JP Morgan in particular. And they drew together to sort of bring assets together in order to resolve the crisis. But after that, the thought was, this is just not going to work in the future. We need a sort of centralized systemic way of ensuring that if banks need liquidity in an emergency, that they can get it. And so what the Congress did was go through a lot of negotiations between many different interested parties. And there were people who wanted a centralized central bank that was private, some that wanted a decentralized one that was public. And essentially what happened, long story short, is that Congress compromised on all fronts, right? So the Federal Reserve is a fascinating institution. It's actually made up of 12 reserve banks that are placed all over the country, sort of in odd places, actually, if you look at the locations, which were sort of negotiated politically at the time. Anyway, there's 12 reserve banks that have sort of jurisdictions, right, throughout the country. And then we now have, after 1935, a centralized sort of head of the system that sits in Washington, right? They have the Board of Governors and also the FOMC, which hosts some of the presidents of the reserve banks. But the fascinating thing about it is that pretty much up until 1935, it had some public backing, but it was essentially a private institution, right? Because the 12 reserve banks were then and are to this day actually owned. They're owned by the member banks, the private banks in the region that participate in the reserve system. So they're private and they are part governed by the bankers in the region. And then in 1935, we essentially said, actually, we need more centralized public direction of this system because it's so essential to the financial system and therefore the economy of the country. And that's when we put in this kind of public capstone in DC. But it's a fascinating thing if you think about it, because the evolution has essentially been a more or less private institution that was established to secure the stability of the private financial system, kind of made public, right? As opposed to if you thought about out of nowhere, let's design a public monetary policy body, right? A public central bank that serves, has public powers and is meant to serve public interest from the bottom up. There's no way you would end up with a system like the one we have today. So it's quite historically driven, and as a result, it's a very odd combo, actually, of private and public that you don't find in very many other branches of the government, actually.
And that insight, I think, helps to inform your argument that you then go on to make in the next chapter about the falsity of some of the theories that we oftentimes use to describe how this system works. I was wondering if you could perhaps go into a bit more detail, not just about the falsity of monetary policy theory, which you've already touched upon, or monetary policy neutrality, but also the credible commitment defense of central bank independence.
Yeah, sure. So this is another space where monetary policy is often discussed and described as quite like unique, right? And therefore it needs unique institutions and unique treatment. And in the book, I push back against that picture. So the most common defense of central bank independence is what we would call a credible commitment defense. And essentially it goes something like this. Monetary policy suffers from time inconsistency, which essentially means that the government, and in particular elected officials, politicians, are incapable of delivering good monetary policy, what's understood as good monetary policy, which is monetary policy that over the long term delivers stable, low inflation. And they're incapable of delivering this, according to the theory, because they are motivated by re-election. And so inevitably, right before the election, they will juice the economy, and that will, in the short term, might make them reelected because it will serve the interests of the people, but in the long term will inevitably lead to painful inflation. And as a result, we need to credibly commit to making the central bank independent. By making the central bank independent, we can credibly commit to securing this better form of monetary policy. And so that's kind of the general story. Now, I push back on this in the book in a few ways. The first is that it's just not clear to me that politicians are these sort of automatons that are only motivated by re-election in a kind of narrow sense, right? So, of course, politicians want to be re-elected, and of course, that means appealing to the interests of citizens and voters, right? But citizens and voters are not dumb, and they understand that there are short-term and long-term interests that the state must serve. So there are cases of time inconsistency in all sorts of types of policies, right? In tax policy, in defense policy, in environmental policy. We have instances where what might be of short-term appeal is not in our long-term interests. And yet, in these other areas of policy, not only do we allow politicians to be in charge, we insist that they be in charge because they are democratically elected. And so it's just not at all clear to me that monetary policy is importantly unique in this sense. Furthermore, the question is a relative one, right? Even if we're presuming to try and find who's going to deliver sort of the best monetary policy, will it be a politician or will it be an independent, insulated technocrat? It's not at all clear that the technocrat won't suffer themselves from time inconsistency. In fact, in the book, I go into more detail of a few instances in which they do, and they themselves recognize that they do. And so it makes their job even harder. So in the book, essentially what I say is that when it comes to this credible commitment argument is that the bar should be quite high for wanting to insulate something as important to democracy as monetary policy from democratic politics, and that the current arguments in the form of credible commitment come nowhere near that bar, essentially. And so we should not be doing it as we are.
What the argument I saw you implicitly making in that part is how these claims of central bank independence are oftentimes deployed with the assumption that you've just hinted at, which is that the alternative functions better.
Yeah,
That it's either Democratic politicians constantly saying I gotta get reelected, so I want to goose the economy, a la Nixon in '72, and that the uh, the central bank governors are like the designated drivers who are going to make sure that the keys are firmly in their hands, and that they're going to make sure everyone gets home safely, and that we're all going to live happy lives. And yet you point out that this is something that is not just a falsity, it's damaging to democracy. And you
exactly.
elaborate upon this in the second part of your book, which I want to shift our focus to now, and talk about um, start by talking about how this approach really does undermine not just the authority that we long ago designated to our elected body, but how it undermines the very institution, the very system that we profess to embrace.
Exactly, exactly. I mean, one way of emphasizing this is so in both the literature, but also in sort of speeches from central bankers and kind of popular discourse, the common analogy, right, for central bank independence is Ulysses or Odysseus tying himself to the mast, right? So the Greek myth goes that Ulysses is sailing past these sirens who have beautiful song, but if you are in charge of the ship, when you hear the song, you will crash the ship on the rocks, and the sirens will, take all your things or whatever. So what Ulysses does to avoid this is he wants to hear the songs. So he tells his crew to tie him to the mast. And so he can hear the songs, but he can't actually, crash the ship. And then the crew puts wax in their ears and they steer the ship past the sirens to safety. And so essentially how the analogy is deployed is to say, okay, well, running the economy hot or goosing the economy or however you want to put it, right, is like the sirens. And so what we need to do is the legislature, Congress, needs to tie itself to the mast and let the central bankers steer us to safety. But there are quite a few problems with this analogy, but I'll just point out two here that I think are particularly useful in the context of your question. The first is just a functional disanalogy, which is that Odysseus or Ulysses has the crew that he can say, tie me up, right? And he literally cannot untie himself. Congress does not have that power. Barring constitutional change, Congress could get rid of the Fed tomorrow, right? There's no formal restrictions on its power over the central bank. So it can't say tie us up. It is essentially, instead of being tied to the mast, it's sticking its fingers in its ears, right? So that's different. But the other more important thing with this democratic point that you're underlining that I make in the book is that Odysseus or Ulysses, when he's tied to the mast, he's not doing anything, right? He's literally just tied up. Whereas Congress is the legislative body of the country. It's trying to do all kinds of things. It's trying to create jobs. It's trying to educate the public. It's trying to deal with environmental crisis. It's trying to, deal with foreign crises. And so it's trying to do all sorts of things, right? And simultaneously, it's essentially tied one arm behind its back by not engaging with monetary policy and by delegating it to the central bank. And even more than that, so it's reduced its own capacity. But not only that, it's actually given a mandate to the central bank to, at times, act against its own interest. So you do get moments where what the central bank is doing and what the legislature is trying to do are at odds. And that just seems extremely strange to me in a democratic context.
Now, what we've been describing up to this point is to is in some ways the easy part. I mean, it's very easy to point to the flaws in the existing system, and a critique that I sometimes have when I read a lot of books is that they're very good on the diagnosis, but then when it comes to the treatment, they all of a sudden get very they clam up. You actually detail some ideas from democratic theory as to how we can not necessarily, dismantle the central institutions, but how we can healthily delegate policymaking power while at the same time ensuring that the responsibility remains where it was originally intended to be. I was wondering if you could perhaps explain a bit how that could be achieved, and what are some of the more specific proposals that you offer for iterative governance?
Yeah, definitely. So as you say, essentially the critique here is that the functional power over monetary policy lies in the central bank and not in the legislature, and that's the problem. And so the question is, this is not a book about rejecting expertise. Rather, it's a book about how can we employ expertise in a democracy rather than being sort of ruled by experts. And the way that I go about doing that is I suggest that what we need is to preserve the power of the legislature over the central bank over time. And to do that, I propose what I call iterative governance, which is that the legislature know and regularly show its power over the central bank. And I suggest that it could do that kind of in two ways. I mean, I give quite a long and detailed democratic theory of why that might be important to a healthy democracy, and then also some of the um, sort of prior theory that might give us reason to think that iteration would be useful for the maintenance of power in this way. But just to get to the examples of the kind of reforms that you asked me about, the form of iterative governance that I argue for in the case of monetary policy, and in particular in the US context, is sort of twofold. One would be a regular rechartering of the central bank. Right. So the first two central banks of the US had mandates that expired, and they were not rechartered twice.
And as you
And
mentioned, that was originally built into the Federal Reserve System in 1913.
exactly. And then in a very strategic political move, it was extended indefinitely by a party by particularly an individual who thought, I don't want this to be open to change in future. So essentially, I would want to reopen that, right? So bring back rechartering, and in so doing, create a forum for political discussion about what monetary policy should look like, right? So what should be the reach of regulation? How much support should we be giving to the Eurodollar market and shadow banks? What should the mandate be? Should we be negatively defining price stability rather than 2%? Should it be 4%, etc.? And then the second form of iterative governance that I suggest would be on a more frequent time scale. So there, I suggest an annual form of credit guidance. So in this case, the idea here would be to create something akin to what you see with other policy institutions, which in the form of budgetary control, right? So every year when the legislature passes the budget, it has to engage with most administrative agencies, right? And it displays some form of power over those agencies. Not so with the Federal Reserve, because the Federal Reserve can make money out of nothing, so it funds itself. So this form of credit guidance would be a way for the legislature to exhibit some form of regular control over the central bank. But more importantly, I think, is it would be a way for the political body, the legislature, to discuss monetary policy and the powers that it has more broadly. So to kind of instantiate in Congress the feeling that if we think about credit policy and investment and where money is going, do we think that that's serving the interests of the populace at the moment? And so the way I suggest doing that would be through what I call a preferred asset taxonomy. So it's quite complicated, but essentially it's a way for the legislature to either say no comment, right? Like keep on doing what you're doing, or to say, actually, we've got pretty stringent opinions about which sectors of the economy should be getting more or less credit, which regions of the countries should be getting more or less credit. Which sort of creditors should we be making it more difficult for them to get credit? Which people should we be making it easier for them to access credit, etc. To essentially comment on the process through which our financial system is allocating resources. And then there's a little bit more discussion in the book about the technicalities of how the central bank might actually implement that. So I offer discussion of differential asset-based reserve requirements, but I'm not sure if we want to go into the details of that here.
Well, I think that's best safe for reading the book itself. So, but yeah, it's I mean, what you're proposing is really interesting, and you are proposing it in a very realistic uh, way, because you're acknowledging both the political context, but you're also acknowledging the global context. In fact, you spend the final third of your book talking about how a lot of these issues that we're addressing, and this whole notion of monetary policy is not it doesn't end at the borders of the United States. It's happening within a global context. You're talking about other global institutions. And this is a book that, while it's focused upon American monetary policy, it does speak to broader global financial policy. And I was wondering if you could perhaps talk about what this approach of iterative governance would look like in a global economy, not just in the context of, say, domestic politics.
Yeah, no, it's a great point, and I think it's worth emphasizing that the book, at least my intention with the book, was that it would have a global dimension kind of in two ways. The first way is that central bank independence and the economic theory on which it rests really is widely adopted, right? So there's a lot of literature on the fact that central banks are sort of unique almost in their similarity across jurisdictions. And part of that's constructed, right? So sort of after the fall of the Soviet Union, the international monetary sort of community actually went out and built central banks, right, in some of these post-Soviet countries in their image. So some of that's intentional. So even though the history and the kind of meat of the book is fundamentally American, the theoretical bones really will apply in other places. And then the second way in which it's global is the one that you're pointing out with this question, right, which is that we live in a hugely globalized and financialized world economy. So how does that interact with this question of democracy, supposing, as I am in the book, that the side of democracy is the nation state, right? And essentially my answer is the following. So I argue in the final bit of the book that really what we face is a choice between sort of global governance of finance and domestic governance of finance, and we've more or less chosen global. So the US is still a very powerful nation, in particular because of its currency being the hegemonic currency of the world. But its central bank and its monetary policy is more or less dedicated to the preservation, as it was at the very beginning, which we've already talked to the private financial system. And that private financial system is no longer domestic. It's deeply international. And so what you saw, for example, in the wake of the great financial crisis and the bailouts of banks that the Federal Reserve made, was most of that money actually went overseas. A huge amount of it went to bailing out the Royal Bank of Scotland, for instance. And, the justification from the Fed for that will be, yes, because those institutions were so interlinked with domestic financial institutions that we had to do that to preserve the integrity of the domestic financial sphere. And they're not wrong about that. But what I simply point out is that essentially what we have is a ostensibly public institution, the Federal Reserve, that is meant to be creating and allocating and regulating money in service of democratic domestic interests, that in serving the private financial sector has essentially committed to a form of monetary policy that seeks to preserve an international economy of asset holders. And the way that I suggest you would change that is that the global system of financial governance that we currently have today rests on domestic independence of central banks. So if the United States were, for instance, to turn around tomorrow and implement some of the proposals that I suggest here that would make monetary policy more strictly under the control of a democratic legislature, that would upset the global governance system in a way that I would hope would create space for other countries to do the same. And it doesn't preclude international cooperation or, financial exchange between nations, but it would mean more stringent domestic control of the financial industry and likely come with more capital controls and things like that. But that's not that unusual. Just go back to the 70s, and that they were very prevalent.
Well, we appreciate the time you've taken to speak with us. But before we go, could you tell us what you're working on now?
Yeah, well, thank you very much for having me. It's been a fun conversation.
Oh,
I
thanks.
I'm what I'm working on next is a sort of two-part project that's concerned with one thing I've sort of discovered while writing this book is, so the seed came from the book, is that a lot of theory fails to, in my opinion, take seriously the fact that life happens over time, right? So I'm trying to take that a little bit more seriously in my work, and it's got my future project has kind of two pieces. The first is thinking about what democracy looks like if you take time seriously. So I'm developing a theory of democracy as essentially collective experimentation. So how can the body of citizens ask itself, what should we do next? Not requiring that we have any sort of internally coherent long-term plan. And then the second is thinking more about time in macroeconomic policy. So very interestingly, we use the term the long run colloquially to mean, calendar time. The long run is 10, 20 years from now. Whereas in economic theory, it's an equilibrium concept. So it's a technical term. And the long run in the equilibrium sense could come to pass right now in the next 10 seconds, or maybe not for another 100 years, or maybe never. And the interesting thing I think is that despite the fact that these two things are completely different, the sort of long run in calendar time and the long run in economic theory, they're used interchangeably by policymakers, more or less. And so I'm interested in looking at the kind of consequences of that slippage, of the difference between those two things. So stay tuned.
It sounds like a really interesting project. I wish you the best of luck with it.
Thanks very much. I appreciate it.
Oh, you're welcome. Leah, thank you very much for taking some time out of your schedule to speak with us. I hope you have a wonderful day.
Thanks, Mark, and you. Bye-bye.